It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and sitting in with us, besides the mayor of Beckerville, Michael Becker.
Hey, Paul.
It's also James Eng. Hello, James.
Hey, Paul. Thanks for having me.
Special episode this week.
Absolutely. We always like when James comes in and gives us a little bit of prognostication about what's going on in the financing side. So I want to kick it back over to Mike. What are we expecting now?
The things I'm most focused on that we have coming up in the Old Capital world, we've mentioned this a few times. We have Dr. Mark Dotzauer coming up on March 28th. Doors open around 6 p.m. at the Grapevine Convention Center. So please go to the oldcapitalpodcast.com website and you can sign up for there. It is a free event, or at least free to you, certainly not free to Paul. So Paul's going to subsidize the speaker fee for Dr. Dotzauer, which is great. He's very entertaining economist. We had, about 300 people at our February event, and we expect to be, probably closer to 500 people at this event. So it'll be not only great information, but you'll have a whole lot of good networking opportunities at 6 o'clock there.
Yeah, networking is an important point to this business. I think Michael makes a good point that if you are trying to get into the apartment business, nobody's going to come to your door, knock on your door, trying to get you into a deal. They're not going to ask you for your money, and you can't ask them to go to their house either and try to get money. So,
yeah. So speaking of networking, the other thing that's a little bit further out, but it'll be here for you note, is the second annual Old Capital Conference. Yep. Be on September 13th. There'll be an all-day event. If you also go to the oldcapitalpodcast.com, you can certainly find the way to sign up for it there. Ticket prices will be going up, so the earlier you sign up, the less expensive it will be. So to try to create a little sense of urgency for everybody to sign up early, that would be great. So go to oldcapitalpodcast.com and you can find out information about both those two events. And there are more than the content almost that and the people you meet, which we think will provide great content and high-level speakers and hopefully some actionable stuff. There'll be great networking. All the players in town from the brokerage community will definitely be there, as well as a bunch of other people that are in the business. So highly encourage you to come out. Last year was a great event.
We definitely appreciate everyone showing up. We also like when people ask us questions too. And under the Old Capital Podcast, there's an opportunity for us to ask a question to Mike. And so for this week, I'm going to kick it over to James and ask the question that came in.
Sure. So, Mike, this question came in to the podcast. What are some common exit strategies that you have utilized on your properties, and what are the pros and cons of those?
Yeah, sure. Really, any deal that you get into, especially when you're taking in capital, you're syndicating capital from other people, the first thing they pretty much always want to know is how the heck am I getting my money back, right? And how and when. And so when you get into these deals, there's usually two primary exit strategies. Obviously, the first would be you come in, you buy it, and you hold it for a period of time, and then you ultimately sell the property, have a capital gain in theory if everything goes well, and then everyone makes a profit on the back end, and then it just really depends on how long it's going to take. And then alternatively, if you come in, buy a deal, especially if you take it on a bridge loan, you come in, buy it, improve the operations, and then refinance it. And they get hopefully a percentage of their money back at the time they refinance it, and then they hold it for a longer term cash flow. So those are your two primary exit strategies. Or there's potentially like a third strategy, which we've implemented on a few of our deals. If you come in, buy the property on a long-term Fannie Mae or Freddie Mac loan, say 10 or 12 years, and hopefully 2-3 years in the deal you're able to increase your net operating income. By extension, you increase the value, and then you could put a supplemental loan on it, which we've talked about supplemental financing on many of the previous episodes, so I won't go too much in depth, but it's basically a second lien cash out note that is coterminous, or meaning having a common maturity with the first note on the. So that's a good way to be able to strip out equity. So those are the main things, but really when you're going through and you're modeling the investment on the front end, you need to make sure you pay attention to what's the primary exit strategy and what's kind of a secondary or third exit strategy that you can get into it. But it's basically sell or refinance. So I don't know if you have any follow-up to my little rant there, James.
Yeah, so a lot of people are trying to either double their money or get to maybe a 70-80% return over 5 years. So sort of a 5-year hold, modeling that. And then they're putting Fannie debt on these deals. What are your thoughts on sort of modeling either the prepay, or is that sort of baked into the residual already? How do people get comfortable with that?
There are prepay penalties on these commercial loans?
So, yeah.
That's the rumor, right?
That's the rumor. So, I mean, on a Fannie loan, most of these deals that are, above $5-10 million, they're going to go Fannie, they're going to be yield maintenance. And so let's say you put a 12-year loan on the deal, then in year 5, you want to sell the deal. what's your options at that point?
Yeah, so I think that's a very critical thing. That's a very nuanced topic here that I don't think people maybe really take into account, and they should. Not to get super granular here and bore everyone, but if you put a 12-year Fannie Mae loan on it, Fannie Mae allows supplemental financing, like we talked about, which is basically like a second lien cash out note. And you have to have at least 5 years of term left on it to get supplemental financing. So when you're going in and you put a 12-year term on an acquisition and you're looking to sell it within, say 5 years, you're going to have 7 years left of term. So supplemental financing is available. So if as a sponsor, you likely need to account that when you sell that property, you're going to sell it on a loan assumption, meaning that the next buyer that comes behind you will have to come in and assume your mortgage. And then most likely, if you're increasing the value of the property, which is obviously everyone's objective when they model a pro forma, that the buyer would also put, say, a second lien on it with a supplemental note. So they should take that into account. If they aren't accounting for that, then they would have to model some large, relatively large prepayment penalty in the future. My basic philosophy is we've always taken primarily we've always taken either 10 or 12-year fixed rate debt out on these deals, and that we always assume that when we sell these things, or we project that we're going to sell them on loan assumptions, and then we've been wrong for a long period of time, right? So we sold most of our deals on loan assumptions, but for the last 5 years, the kind of my history of owning and operating apartment complexes, pretty much across the board in almost every circumstance, would have been better to come in with some sort of floating rate loan with open or small prepayment penalty on it. And we would have been, better off selling it free and clear versus on a loan assumption. Well, now, looking at the current economic environment, we're in February of 2018 as we record this podcast. Over the last 2-3 months, rates have risen, pretty sharply on the 10-year Treasury. So hopefully all these loans that I put on in 2016, 2015, 2017 that have low 4% interest rates on them, hopefully in the future, if rates are in the mid 5s or 6s or even higher, it should be accretive to our situation to be able to offer this deal with a loan assumption at a well below market interest rate loan. So that is the theory that we've been going off of for a long time, and we'll see kind of how the marketplace actually plays out.
I would tell you that I like that theory. I like how that plays out, just because being former bankers, James is a banker too, but you never know when the angel of death is going to knock on your door and everything goes to shit, so to speak. And you want to protect your balance sheet. You want to protect your client, the people who put money into these deals, and you try to go on longer term possible, because you always can bear down and always pay your mortgage, but you don't want to have a short maturity coming with the banks not be able to lend to take that loan out, and then you do have a major problem. Yeah,
I've referenced this many times. A lot of the people that we saw get in trouble, now a decade ago, it's been that long since the last major economic down cycle. Really, they would have been able to survive, except that they had a loan maturity, say in 2009. The capital markets are pretty much frozen. So when your loan comes up for maturity, the banker's playbook is to remargin my loans, meaning pay it down, so they're normalized loan to value, so then they can extend your maturity out. Well, if you're in a bad environment, your equity partners either are unable or just simply unwilling to give you more capital to allow you to do it. So then that forces your hand to sell it at a bad time when the pricing of the apartments are down, and then you just have a whole bunch of bad options, and that's what caused a lot of people to get in trouble.
You do not want to see the angel of death knocking at your door.
Yeah, unfortunately, I was the angel of death for a few people about 10 years ago. So it was a good experience in retrospect, but it was certainly no fun at the time. So James, I don't know if you have anything else to add to that.
So I think the important point is really matching your exit strategy with your debt. And if you look at a deal and you want to be in the deal for 2 or 3 years and you think in bridge loan, make sure there's enough cushion in the deal to make sure you can get out and refi, or at least have some options to pay it down if you need to, if there's an interest rate hike or a downturn in the market. So a lot of people, if you can, do a Fannie Freddie on the front end and build in a little cushion and make sure you get that interest rate fixed, that's what a lot of people are preferring. I
would also throw out too, we like the 10, 12-year term loans, because if you do a 5 or 7 year loan, yes, you'll have a shorter maturity on that loan and you have a reduced prepayment penalty on it. But when it comes to that, also that you may have your loan proceeds cut too. So instead of getting 80% maximum leverage in a deal, if your area is available for 80% maximum leverage, you may only get 70 or 75 with a shorter term.
And less interest only.
Yeah, so just that's all very specific to whatever transaction you're looking at. So just pick up the phone, shoot us an email. James, maybe since everyone knows the Paul through the podcast, what's the best way to reach out to you if someone has a question about financing a transaction?
Sure. So you can reach me on email, jeng@oldcapitallending.com, or my phone number is 214-300-5035.
Second smartest guy in the room.
Which one, me or James?
I'm not going to mention a name today, but if someone wanted to get some additional information and know how to partner with you, Michael, what's the best way of getting in contact with you?
Yeah, certainly. If anyone wants more information about what we do at my company, SPI Advisory, the easiest way, simply go to our website, which is www.spiadvisory.com. That's SPI like spy advisory.com. And there's a contact us form. Fill that out. I'm always happy to have a 10 or 15 minute telephone call with listeners of the podcast to let them know what we do at SPI.
SPI stands for?
Strategic Property Investment.
I love it.
Yeah.
So it's not
very generic.
It's not too often that James Eggs is hanging out with us, but we appreciate his time coming in today. Michael Becker, always a pleasure. I'm Paul Peebles. Have a great day.